Hello everyone, and once again welcome back to another video. So by taking a look at today's chart, you may be left to wonder why I've decided to add all of this extra information and what all of these extra colors and lines mean. Well, I've done so to prove a point, and the point being that whenever things can be kept simple and easily understandable and digestible, they should be kept that way. And I'm saying this because whenever I started getting interested into this world of Forex, and I would be naturally attracted by the free courses and free seminars that the social media are full with. This is the sort of stuff that I would be receiving as a result. A bunch of indicators, of oscillators, of guidelines that would promise you to predict future movements just by looking at this line here, and when it crossed over here in conjunction with the Bollinger Bands, you should sell, you should buy in this region. All of this is nonsense. All of this, so the RSI, Relative Strength Index, and the stochastics are lagging indicators. So they are indicators that can only go as far as the historical price in order to roughly predict what could happen in the future, just by saying, okay, this area is an overbought area, so we are expecting a correction to the downside, and this is the moment where you should sell. But there's no guarantee for that. It could be anyone's guess. Granted, there's a lot of studying mathematical equations and models behind this, so an element of truth will be there. But the point I'm trying to prove is the fact that it does not need to be made that much of a difficult experiment or experience when trying to understand something about price action and the world of forex trading. So whenever you see something like this online on Facebook or Instagram, please shy away from them because they will not be able to provide you with the genuine information to be able to read a clear chart with the relevant price action. So what I would do, and what I believe you should do as well in order to gain some further clarity, is to go on the object tree on TradingView and delete everything. Okay, so after clearing up your charts, you're then finally presented with a much simpler picture, which in turn will then allow you to carry out a more effective chart analysis, because once again, you've managed to eliminate all of the confusion and unnecessary data. So for today's video, I've thought about the fact that in previous episodes, I may have got too much into detail too quickly without providing a basics explanation of the first steps into Forex, and explaining the basics terminology to then build upon the prior knowledge. So I'd like to start off by talking about the unit measurement of Forex. So whenever we think about the main metrics that we use every day in our daily life, such as length or weight or distance and things like that, we then are used to using units of measurement such as pounds, kilos, centimeters, kilometers, and so on. And the world of Forex sort of like adopts the same philosophy by using a standardized measure to determine the variation in prices, and this would be called a pip. So in Forex trading, the unit of measurement to express the change in value between two currencies is called the pip or percentage in points. So for example, we're taking a look now at the euro against the US dollar. So if the euro against the US dollar is trading currently at 1 spot 1050, for example, and the price rises to 1 spot 1051, that 0.0001 USD rise then would represent a movement of 1 pip. So 1 pip is the fourth, usually, because we'll take a look at why, usually the fourth digit after the comma or the point, depending on whether you are in the UK or Europe. So, however, there are some exceptions. Most currencies, like I've said, go out to 4 decimal places, but some currencies, like the Japanese yen, for example, they go out to 2 decimal places. And I'll show you what I mean. So by taking a look at the Japanese yen, in this case is traded against the US dollar, ignore my analysis, but the point of this would be the fact that price is no longer 1 point something else, is 110.30 or 0.40. So in this case, a pip would be the number 3 or the number 2 or the number 1 that you see here, and no longer the fourth digit after the comma or the point. So that's important to clarify, so that you guys have an understanding of what a pip means. And whenever you see people saying, "Oh, I've managed to do 100 pips this month or 1,000 pips," that's exactly what they mean, a percentage in point. So moving on, another very important factor within Forex trading is the understanding of a candlestick. So you see these charts, and every single bit is made up of candlesticks. So candlestick is nothing but a type of chart which is used to display the highs, lows, open and closing prices of a security for a specific period. And the concept of a specific period is really important because, as you can take a look at here, we're now studying the weekly chart, meaning that each candlestick represents 1 week of price action within that specific security. If we go down to the 4 hour, for example, guess what? Then each candlestick will then represent 4 hours of movements, and then 50 minutes, and so on and so forth. Look how many options we have. So it is quite important to then know your time frames very well, because they would depict a different picture. Because you're looking at time frames that could be either very brief or very expanded or enlarged, such as, look, we can go as far as the 2000s or the 1990s. So it's important to know the differences between the time frames to carry out an effective chart analysis. So with regards to the anatomy of a candlestick, and by anatomy I mean the shape of it, the way that it's built up, I'd like to take a look at maybe this one here, for example. So if we take a look, and I'm just going to highlight it by doing so. If we take a look at this red one, for example, so I've talked about the concept of highs, lows, open and closing prices. So whenever you see and by the way, all of these colors are arbitrary, so I could have selected all of these colors here from the color panel. So anyone else could have their green, my green could be their black, or my red could be their yellow, for example. That's completely down to you. But the concept is, whenever you see generally a green or blue candle, that's when in that specific period of time, that security, in this case the euro dollar, has increased in price or in value. Okay, so the US dollar has got stronger against the euro in that week in this case. Okay, so price in this week has gone up until this level, and then the red candlestick starts to take place the week after. So this is where it would begin, because of the fact that the opening of the next candle coincides with the closing of the previous one, right? So we can see here on the right hand side that it closed at roughly 1.1749. During that week, price was quite volatile, so went up there, forming these highs. These are called wicks or shadows. It then retraced back down to the lows at roughly 1.1570, and then it finally closed the week at 1.1603, which then, guess what, coincides with the opening of the next one, and then the closing of the next one, and so forth. So everything is tied in together through this magic of the candlestick pattern, which was discovered a long time ago and still now is considered to be amongst the most well-known and recognized ways of looking at a chart within trading and other securities as well. So after explaining briefly what candlestick is, I'd like to conclude this first introduction by explaining the concept of support and resistance. Okay, so whenever you see a chart that could look like this, then you may be wondering at which point then price decides to go back down or go back up. In other terms, what causes these major fluctuations and volatility? Well, there's a lot of theories behind this. There isn't one simple answer. But the rule of thumb would be that price is usually driven by the laws or the rules of support and resistance, which in turn are then also ruled by the laws of demand and supply and demand. So if we, for example, drew a line here or a ray, which cut through exactly this level here, 1.2431, then we can see that this line seems to be quite important, because whenever price impulsively reaches this area, it then gets rejected, and then it tries to reach it again, and then it doesn't manage to do it, unless there's a very impulsive breakdown or breakout, which then breaks impulsively through that level of price, but then guess what? It goes back into that region. This means that this level upwards, so all of this here, is a very important zone, because the fact that big bankers, brokers, and hedge funds they do want price of the euro against the US dollar to stay within this region, okay, for various reasons. Then when finally price comes back down, guess what? Then that level still remains important because of the fact that in the past that was a very sort of hot area, and it then becomes the area that rejects that price for another further movement to the downside. So this line here is support and resistance at the same time, relatively speaking, because it still depends on what side of the charts you're looking at. So if we take a look at support, for example, at the concept of support, so this occurs when falling prices stop. So falling prices stop falling, they change direction, and they begin to rise, like we can see multiple times. But in order to just make a concrete example, we could see here. So price comes down, it stops falling down, gets rejected, and it goes back up. So this would then represent an area of support, like we've seen. So it's often viewed as a floor, which in other terms is supporting or holding up prices. Okay. Then, like I've anticipated a couple of seconds ago, it then goes back into it and it gets rejected by the same sort of area. Granted, this is called like a region. As you can see, there are wicks here, part of the candlesticks, which I've just explained. So support and resistance aren't an exact measure or an exact science. They represent like an area whereby price is critical. It reaches a critical point, at which point it then either gets rejected or it breaks through and then retests it to go to the upside in this case, which could have done so. Price could have done this, retested this level, and then gone back up to create a further trend to the upside, for example. But that didn't take place, and the price went back down. But to get to the point, this is no longer called support, but it's called resistance. So what was once the support for this price action level or area or region, it then turned into resistance. Yeah. So it's important to understand that when people talk about support and resistance, they are just talking about the same concept. The only difference would be the perspective that you're employing to look at it. So in this case, the same line represents two things depending on the side that you're looking at it. So I'd like to keep this video quite brief because I'm quite eager into spreading the world of Forex, but I'd like to do this quite slowly and taking the step-by-step process. So from now on, I'd like to then introduce these topics as I go along, so that if you guys are watching these videos or listening to the audio in the background, you then can start gathering an understanding gradually over time of what this concept mean, and then marrying it with something else, and then adding up to prior knowledge, so that over time you then will be able to gather up a good baggage of knowledge and understanding, which hopefully will then lead you to nurture your talents and carry out some analysis yourselves. Okay, so thank you very much for watching, and until the next one, cheers.